I'm Barak Berkowitz.
I'm Dave McClure, or Fred Flintstone, depending.
And I guess this is the fire for our fireside chat.
Thanks, you guys are awesome.
Thank you.
Please tip your waiters. We'll be here all week.
Exactly.
Try the liver.
So what I wanted to do was talk to David about investment philosophy, 500 startups and what that means.
What a crazy number.
What a crazy number. So let's just start there. What made you start 500 startups? And why 500?
Probably because I couldn't get a job at any other venture capital firm. That's not completely true. I worked for Founders Fund for about a year and a half, Peter Thiel and Sean Parker. But I really wanted to start my own fund and wanted to combine investments in both accelerator programs, early stage, as well as seed stage. And we wanted to do that all over the world.
So one of the things that you might say about 500 startups is that before 500 startups, maybe a couple of other funds, people used to think, oh, I'll invest in 10 companies a year. Maybe 20 was a big fund. And suddenly you're investing in how many in a year in your first year?
In our first half year, about 100. In the first full year of operations, over 200. And I think last year we did over 500 companies.
So how can that work? I mean, how can you screen 500 companies? How can you choose winners in 500 companies?
Well, I think I would sort of argue that the venture capital profession is a little bit high on its own supply sometimes and somewhat arrogant in thinking they're better stock pickers than they really are. Typical industry data would indicate that Series A investors pick a unicorn about 1% of the time. Maybe the Sequoias of the world or benchmarks pick them, 5% of the time. But still, it's pretty infrequent. At seed stage, it's even more infrequent. And most VCs don't really beat the market. In fact, probably half of the VC funds don't return 1x. Another quarter may return 1x, but don't really beat the market. So the asset class really is not a very great story, at least in the median case, maybe in the average case. But that's only because some funds do really, really well every once in a while. And so we were trying to figure out a way to get a little bit more statistically predictable distribution of outcomes. And, at least from the data that I had been gathering over the last, 5, 6, 7 years or so, it seems like that number is at least more like 100 and possibly as many as 500 to really get predictability in kind of outcomes.
So then how do you look at 500 companies?
We actually...
How many companies do you have to look at to get 500?
I was going to say, we actually look at more like 10,000 companies a year. Our accelerator programs probably get, anywhere from 1,000 to 2,000 applications a quarter. So overall, I'd say we have about 30 or 40 people looking at companies, but overall our acceptance rate might be around 5% or less than 5%. So we do have to look at a lot of companies, but I think, venture capitalists tend to overthink their contributions to the company. And we tend to think that mostly it's the entrepreneur and their execution that matters, not necessarily our advice. Sometimes it's our dollars, although we're usually small investors early.
Right.
So we try and be helpful, and we do try and offer advice, but most of the time we're trying to find great entrepreneurs and great teams, and that's pretty infrequent. So we have to make a lot of investments to get a few of those.
But meanwhile, you've got, compared to a big fund, a moderate-sized fund today, and a small fund when you started.
Right.
And yet you have a staff of 100-plus people?
We have about 130 people or so spread across maybe 20 markets, mostly maybe about half in California and the other half spread across 15 to 20 other countries. But we don't pay ourselves as well as maybe the average VC that has maybe $1 million a year salary. So we pay ourselves more like, startups, probably between 50 to 200,000.
Right.
And we need to make money on carry in order for that to work.
So effectively, you're spending like 10% of your fund on staff?
Well, our overall budget is probably around maybe 18 to $20 million for those people.
Your newest fund is?
And management funds under management is about 260 million. But management fees are probably less than half of our overall revenue. So a lot of revenue comes from the services businesses that we do, our events and conferences, some corporate sponsors and partners.
Okay. Somebody may want to start the clock, or we're going to go on forever. But
if you guys can pull up the slides, maybe
but
we
if
can
you
talk
can pull
about
up the slides, so let's just kind of talk about the other thing that you do that a lot of people don't do. You talk to some investors who are like, I don't want to invest in any place that's that's more than a 1-hour drive from my office. And where do you invest?
I mean, I think again that's optimizing for board seats. I think a lot of VC fund thesis is optimizing for how many board seats can I reasonably do, and how far do I have to go to those board meetings. And some VCs will go as far as maybe LA or New York, but we actually think that the way we construct portfolios is based on how often do we find wins, and we invest in people all over the world, again, because we are investing in the entrepreneur, we're not investing in us. And so our proximity to them for board meetings is not part of our investment philosophy. It's whether they fundamentally have a good product, whether they have a good team, whether that market is interesting.
So maybe we could put, is the slide up?
Yeah.
So maybe you could talk a little bit about how you invest all these places at one time.
Yeah, so we have probably only 1 to 3 people in a lot of those markets. A lot of times they're in coffee shops, not in big office buildings. And typically most of the people on our investment team are doing maybe about 20 investments a year, usually 1 or 2 investments per month. And we don't think it really takes a lot of time to evaluate the company. Our process for due diligence is really looking at the product, looking at the customer metrics, talking to the team, maybe doing some follow-up calls with customers and other references. But we're going to make a decision pretty quickly within 1 or 2 meetings. And it may take a little bit longer to process paperwork and do wires, but I think when you're investing really early, there's not a lot to do due diligence on, and so you have to make a pretty quick and slightly informed decision, and you have to know that you're going to be wrong a lot of times.
So we actually just had this conversation for a second outside, which is a lot of VCs never want to say no. Because they always want.
Well, they say no all the time. It's just in interpretive
the way
dance
they say it.
movements
They never want to say.
no.
They want to say not now. Do you say no?
Not now. We'd like to see a little bit more traction.
Yeah, exactly.
Come back and see us when you have a little bit more traction.
We love the deal.
Otherwise known
just come
as
back.
no.
Right. Do you say no?
We try and say no pretty clearly. Hopefully we do. I mean, we're not perfect, but usually we want to say no and here's why. Or at least if we say no, not right now, it might be, we're expecting this level of traction, you have this level of traction. Right. Not come back and see us when you have more traction, but come back and see us when you have $20,000, $50,000 a month worth of revenue, or twice as many customers or something. But we have people in most of those markets who speak local language, usually are people from those markets. So it's not like it's a bunch of white guys from Silicon Valley. It's a bunch of different people all over the world making those investment decisions.
And they're making decisions independently of you?
For the most part. I mean, we do have some oversight and see kind of what the deal memos are, but we try and encourage independent thinking, and at least on first check decision making, we're not really second guessing them. Okay. Maybe if we're thinking about doing a second or third investment at a larger check size, then there might be a little bit more committee-based decision making. Okay.
So maybe we can just kind of walk through the waterfall of what you do and why this works. To your mind?
So this is our brag slide. So people kind of ask us, like, how is that possible that you've invested in all these companies? And we try not to really convince them of the process. We show them the results.
Right.
And so out of all those companies so far, at least, maybe the first 500 or 600 companies, we've been able to find 3 pretty large billion-dollar outcomes and another 30 or 40, 100 million plus outcomes. We just had our first IPO with Twilio about 3 months ago. It takes a long time, at least for most companies to get to IPO. So I made that investment at seed stage. when I was in Founders Fund about 8 years ago, we made investments in the B and C rounds in 2011 and 12 out of 500.
What would you say is in common with the companies you invest in?
Nothing other than smart people. Well, I mean, we do a lot of investments in e-commerce and marketplaces and SaaS, but these companies are across a wide variety of industries. Credit Karma is a fintech company that does, credit score monitoring and evaluation, and basically does lead generation for financial services and lending. Twilio is a platform for SMS and text notifications. If you've ever used Uber or WhatsApp or a bunch of other voicemail services and text-based services, they're probably using Twilio somewhere in there. Grab is a competitor to Uber in the Southeast Asia market. So, we invest in a lot of things. Primarily, we're looking for functional product, early customer usage, and modestly, diverse team across engineering, marketing, and design. But other than that, it's in a lot of different types of industries.
So at the Media Lab, I'm obviously like working with stuff that's very far over the edge. And do you try to see into the future, or you're interested in now?
Our ability to see into the future is pretty cloudy, we would say. I think we all have sort of intuition for what might be around the corner, but a lot of times we're trying to let the founders do the crystal ball gazing, and we're trying to look really more at customer usage models. In that sense, we're probably more risk averse than most traditional VCs that are looking at capital intensive models or models based on intellectual property and really building out the next generation of maybe, virtual reality or drones or AI or other things. We do those things, but we tend to like things that are transactional model based and have some customer validation usually.
So maybe we could walk through kind of what the waterfall of your company looks like.
So this is maybe just an idea of thinking about how companies get from bootstrap to down to an IPO or a large company, and there's a rough cut down here that's indicated based on accelerator, seed, Series A and B, and I'm kind of been trying to indicate why there's a lot of in the middle investment required to get to those stages. If we look at sort of our historical data from Fund 1 and Fund 2, which were 2010 and 2012 cohorts, maybe close to 600 companies. About 25% of those got to a Series A, maybe half of those, or a little bit more than half, got to Series B. And kind of when we start to think we're really making money at Series C or D or really 100 million plus valuations, it's really less than 10% of portfolio. Probably only 5% of our companies get to that 100 million plus valuation, maybe 5 to 7%, and probably only 1 to 3% that get to sort of billion-dollar unicorn outcomes. So if you're only getting that, sort of big unicorn outcome 1 or 2% of the time, kind of no secret that minimum size portfolios for us to have statistical predictability are at least 100, if not more than 100. And we kind of feel comfortable somewhere maybe between 250 to 500 companies. Our first two funds were around 250 to 300 companies, and our third fund was over 600 companies.
So if I get an investment from you, I should not assume I'm all that special. Is that right? This is not. Not a stamp of approval.
You're all a beautiful snowflake, but you're only special in the Olympic sense of the word.
The one snowflake that doesn't melt.
Again, we try and help all of our founders, and we try and be optimistic. But yeah, we kind of know that we're going to be wrong about 50 to 80% of the time, and we'll be right, really right, probably only more like 2 to 5% of the time.
So let's just for a second, and we'll figure out what the timing is here since we don't have it.
I think we continually have 15 minutes.
Yeah, we have 15 minutes for the rest of the
you have another
conference.
2 minutes.
Good. So one of the confusing things I think everybody faces is what's an accelerator, what's an incubator, what's a seed, what's an A. I just was talking to a friend of mine, Shulkat, who says he's doing a $6 million seed. What is,
Yeah, there's, very, very crazy valuations in certain parts of the world where occasionally people are doing, $30 million Series A rounds, which I think is insane. I think people try and find labels for the categories and strategies that they're going after. For us, we've kind of stopped calling it an accelerator now, I guess because we're trying to differentiate from the rest of the market, where a lot of people doing accelerator are kind of still working on an MVP. They probably don't necessarily have customers or a lot of revenue. We have companies coming into our programs now that are doing, certainly $50,000 to $100,000 a month. In some cases, even, doing a couple $1 million a year. They may have even raised $1 million or more. So I don't know. We kind of don't really want to call it an accelerator more because people always think that accelerator, that's like the small penis program. Hi, we're running a program for small penises. Anybody want to do that program? Probably not too many people, right? And so when you say
we've got one,
you're running an accelerator, yes, that's Adam on our team. Adam says, yes, I have the small penis. So we kind of want to emphasize what we're doing, not hey, we're the program for really short midgets in high school. We're generally trying to find companies that already have functional product, already have customers, and we can work with them on growth marketing strategies to accelerate that.
Right.
Hopefully to Series A metrics.
So to wrap up, I think that the net of what we've said here is, if somebody gets an investment from you, they're not all that special.
This is like the best sales pitch ever, right?
If they're going to be an entrepreneur and run a company out for 10 years, the odds of them succeeding are incredibly small, and they better love what they're doing.
Let me rephrase that as, we'll make a quick decision, we'll give you some money, we'll try not to be an asshole, we'll connect you to all the investors and mentors in Silicon Valley or around the world, and we're experts on growth marketing.
Awesome. Thank you.
There you go.